Hello, everybody, and welcome to another 18 Minutes with 180 Markets. Well, friends, for those of you that watch us, you know we always say you must be on the correct trend. That is right. But what's even better is when you get on that trend early. And we want to talk about Australian commodities and specifically iron ore, magnetite, because those markets are starting to turn. Iron ore is at a 5-month high, and China, the main driver, has put out, and I'm reading here, quotes about how they are expanding their Yarlung Sangpo River Gorge project, which is a long-life, multi-trillion yuan project. And how can we then take advantage? Well, we are joined today by Hawsons Iron CEO Tom Revy, because Hawsons is perfectly positioned to take advantage of this mega trend. And with that, Tom, welcome.
Thanks very much, Greg.
Hey, Tom, I talked about how the tide could be turning here for magnetite and iron ore, and maybe that's a great place to just start out and just give us an overview of the Hawsons project.
Sure. Well, basically, the Hawsons Iron Project has been around for a little while. The company has spent quite a bit of money getting it to where the advanced stage of where it is today. In terms of location, it's ideally located. It's about 70 kilometres from Broken Hill. And of course, Broken Hill is a long-established mining centre, even on global terms, with an accommodating population. And that's what we've certainly found. So in terms of interactions with the farmers, with the Broken Hill community, with the Aboriginal Land Council, it's all been very positive. Being situated where we are, 70 kilometres away, means that there's no sound issues, no vibration issues, no dust issues, and yet we're close enough to take advantage of the amenities associated with Broken Hill. We're 40 kilometres from 2 major highways. We're 40 kilometres from a rail line that will take us straight into Adelaide, and also 40 kilometres from a power line that takes the power from Mildura into Broken Hill. And keep in mind that a lot of that power is associated with renewable power, given that the Broken Hill district is well sort of endowed with the right credentials when it comes to solar and wind power. So it's a great location to be based in. The project itself is large. It's got over 4 billion tonnes in resource, and it's got a very large measured and indicated resource. And of course, we're on the public record of saying that we'll be publishing a reserve in the not too distant future. And we believe a lot of that measured and indicated will convert into reserve. The product itself is highly sought after, again, keeping in mind that only about 4% of the global production of iron ore exceeds 67% iron. And what we're talking about is a product around about 68.5% plus. So it's a very high purity, high demand product right, moving forward. So, and it's got upside. It's got significant upside in terms of whether you're talking about resource upside, whether you're talking about capex, opex decreasing, etc. That is what we're doing now as part of our pre-feasibility study.
Right. Hey, Tom, it's all about the future. And maybe talk to us a little bit about the steel mills in Asia, the type of product that they will be looking for, maybe not now, but in 5 to 10 years' time, and how Hawsons can supply that type of product into them?
Yeah, well, the world is concerned rightfully about global gas emissions, global carbon emissions. And the 2 biggest industries that contribute to that globally are iron ore and cement, or specifically steel and cement. And of course, iron ore forms part of that steel supply chain. So the world is very cognizant that it needs to do things in these 2 industries to have a material impact on those emissions. And so a lot of the focus these days is on how can we make greener steel production. The Japanese, the Koreans, the Chinese, the Indians, the Europeans, they all agree that what needs to happen is we need to apply known technology in a way that can produce this greener product. And that's where Hawsons comes into it. And of course, we're not alone. You know, when you talk about magnetite and people saying, well, I'm not sure about magnetite, there are plenty of believers. Vale, one of the biggest producers of iron ore in the world, have been producing magnetite for decades, particularly out of their Samarco operations in Brazil. Hancock are looking at a number of magnetite opportunities at the moment. They're on the public record of that. Fortescue last year commenced their Iron Bridge magnetite project. CITIC Pacific, one of the largest companies in China, actually operates the Cape Preston magnetite project. And of course, there's the Carrara magnetite project in WA as well. So big companies know where the future is. They're already going down the path. If they're not producing already, they're in that development pathway. And what it means is that we'll be able to supply that product, that high-grade iron product, into the supply chain, which could mean that it enters into a direct reduction iron product or a hot briquetted iron product, which feeds an electric arc furnace, which at the end of the day, the world is trying to push towards, because that's where you're lowering emissions.
Right. Hey, Tom, and it's not that you're just saying it. The market also is proving that. And the way it is by the premium that the market places on your type of product. Isn't that correct?
That's right. And as I said before, world production is about 4% of global iron ore production is in excess of 67%. So the world wants it, can't get it. So that attracts that premium. At the moment, and in consultation with various industry consulting experts, it's fair to say that premium is generally about 30 to 40% above the 62% iron price. So it is attracting that premium already. More and more downstream plants are being built, and there's not enough feed coming into it. So whilst we're looking at it conservatively, we tend to bank on a 30% premium. We believe that premium is going to grow over time as that gap widens between suitable feed into a DRI plant or a HBI plant and the number of DRI HBI plants that are currently in development.
Right. And Tom, so this is the revenue side, as we always discuss, but everybody also in commodities wants to be in a lower cost quartile as well on the other side. And maybe talk to us about where you would potentially fit in your power cost and the softness of your product.
Yeah. So what we have, and I know a lot of people always say this, that my product is unique. And I get that. It is. In fairness, every ore type.
Like my children.
And and you love them all. And so it's really important to understand what you have in the ground so that you can apply the right technical processing applications to that material that give you a consistent product, because that's what off-takers are looking for, but also, as you brought up, to be in a lower cost area. From our perspective, a lot of the magnetites around the world are a hard, what's called banded iron material. It's a hard rock, and it's basically, to put it in perspective, the work index, not that the units will mean much, but the work index is generally about 18 to 25 kilowatt hours per tonne. Right. Our material is 5 kilowatt hours per tonne. So let's say a quarter of the power necessary to crush and grind compared to our peers. And of course, most people understand that power costs are one of the major costs associated with any mining operation.
Of course.
So there we have a massive advantage already. In terms of the approach that we're adopting, our material is soft, and we've only sort of worked on this in the last sort of 6-8 months, is because our material are discrete magnetite particles. They're clean, but they sit within some silicates and some mica. And again, some people might be aware of mica. It's a very layered material that is relatively soft, which means when you apply compression to crush our material, it breaks down very easily because it's sliding along those mica planes. So that's what gives us our uniqueness, for want of a better phrase.
Right.
That translates into, as I said, lower power costs. And what we've decided, based on the last 12 months' work, is to pursue a dry comminution or crushing and grinding circuit. And what that means is that we've been able to drop the power by about a third, as much as a third, by going from a typical hydromet processing facility to a dry facility.
Okay.
Secondly, we've also been able to decrease our water consumption or projected water consumption by 2/3, which is monumental, not just in costs, but in terms of environmental implications. And when you think about environmental implications, that flows all the way through to a tailings dam, which traditionally is a long life sort of environmental legacy that needs constant review. In our case, because our material coming out the other side will be dampened for dust suppression reasons, it will be mixed with mine waste and put into what we're calling a co-disposal facility, and we'll be able to rehabilitate that as we go along. So again, because it's not just cost benefits, but there are social and environmental implications, which means that permitting, for example, should be shorter on the basis that we are greener than our peers.
Right. Tom, as we said, Hawsons, I think we've established this is a great long-term, big size prospect. But now turning it towards the short term, over, let's just call it the next 12 months, what should investors be on the lookout for as major catalysts?
Okay, so we're on the record as saying that we've just completed a capital raise, so there won't be a capital raise in that period of time. But what we're
filming in July of 2025, I have to interject.
But what we will be putting out is a mineral reserve, and the reserve will reflect this new dry comminution approach. So it'll be a maiden reserve coming out at the same time as an optimised pre-feasibility study. And we're saying optimised pre-feas because basically a pre-feasibility had been completed previously. We're in a position where we can take a lot of that pre-existing information relating specifically to the logistics, etc., accommodation, and we'll be able to integrate that into a new process flow sheet which Stantec engineers are working on, and we'll be able to compile that PFS. So later this year, what we'll be doing is publishing the CapEx, OpEx, NPV, IRR, all the normal outputs of a pre-feasibility study, and that'll put this project in context with other projects and other show to be a great opportunity.
Right. And Tom, I assume also once you put out those numbers there, industry players, no doubt they will take a look as well, won't they?
Absolutely, because it won't just be the numbers, but it'll be the de-risking. Because what we'll also be looking to do is we'll be looking at carrying out large diameter drilling to be able to take bulk samples and pilot at a large scale, and consequently get things such as process guarantees from equipment suppliers, which again de-risks the project, but also provides us that really critical information, the process design criteria, the energy requirements, the equipment sizing, etc., that you need for a typical definitive feasibility study. So we're taking uncertainty out over the next 6 to 8 months, which is an important step towards focusing purely on a single option outcome in terms of the feasibility study.
Right. Hey, Tom, we have to keep it short, but if there was one or maybe 2 points you would like every investor or even a prospective investor to know about Hawsons Iron, what would they be?
Well, basically, it is the parameters around the project. It's very much about this is a potential large, long life, important globally project. And so it's gaining a lot of international attention, and we're talking to various groups of people about that. So it's very, very material project in terms of Australia and internationally, and because of that, we're getting good government and local support out of that. Secondly, as I mentioned before, our material is unique, and that uniqueness does translate to some huge benefits for shareholders moving forward in CapEx, in OpEx, in environmental aspects, in scheduling, in permitting, and those sorts of things. So we believe we're onto a winner. We think that those aspects, with upside of still available, still exist, presents a great investment opportunity.
Great. Tom, we very, very much look forward to it. Thank you so much for sharing your time today.
Thanks very much, Greg.
Bye-bye.